The Intelligent Investor by Benjamin Graham is considered one of the most important books ever written about investing. Graham was a teacher, investor, and mentor to many successful people, and his ideas have stood the test of time. His approach was not about getting rich quickly or making risky bets, but about building wealth steadily through smart decisions. The book is full of principles that can help anyone, whether they have a lot of money to invest or are just starting out. These ideas are not complicated, but they require patience, discipline, and a clear understanding of how money works. One of Graham's main lessons is the importance of viewing yourself as a business owner when you buy stocks. Too many people treat stocks like lottery tickets, hoping the price will go up without caring about what the company actually does. Graham teaches that buying a stock means buying part of a business. If the business is strong and well managed, it can make money for many years. Thinking this way changes your mindset from chasing quick profits to building lasting value. Another important idea is to focus on the margin of safety. This means never paying more for something than it is worth. If a stock is worth $100 based on its earnings and assets, but you can buy it for $70, you have a margin of safety. That gap protects you if something goes wrong, such as a drop in earnings or a market downturn. Without this safety margin, even good investments can turn into bad ones if the price you pay is too high. Graham also emphasizes the difference between an investor and a speculator. An investor makes decisions based on careful research, facts, and a long-term outlook. A speculator bets on short-term price movements, news headlines, or market hype. Graham warns that speculation is not necessarily wrong, but it should be done with money you can afford to lose, not with your main savings. The majority of your money should be invested, not gambled. Patience is another theme that runs through the book. The stock market will always go through ups and downs, sometimes for reasons that make little sense. Graham compares the market to a person called Mr. Market, who offers to buy or sell you stocks every day at different prices. Some days Mr. Market is optimistic and offers high prices. Other days he is fearful and offers low ones. Your job is to take advantage of his mood swings, not be controlled by them. If prices are too high, you can wait. If prices are low and the business is solid, you can buy more. Graham also believed in the value of diversification. This means spreading your investments across different companies and industries so that no single failure can ruin you. Even the best research cannot guarantee that every investment will succeed. By owning a variety of assets, you reduce the impact of one mistake or bad year. Diversification is a simple way to protect yourself from unpredictable events. Another lesson is to focus on the long-term earning power of a business, not just its current stock price. Prices can move up or down based on fear, excitement, or market trends. But the true value of a business comes from how much money it can earn over time. If the earnings grow steadily, the stock price will usually follow in the long run. This is why Graham encourages investors to read financial statements, understand a company's products, and know how it makes money. Graham also stresses the importance of discipline. Many people fail at investing because they let emotions take over. They panic when prices fall and get greedy when prices rise. A disciplined investor sticks to a plan, buys when investments are undervalued, and holds them for the long term. This discipline prevents costly mistakes and helps you benefit from compounding returns over time. Another point in the book is about keeping your investment approach simple. Graham does not recommend chasing complicated strategies or timing the market. Instead, he suggests building a portfolio that balances growth and safety. For many people, this can mean a mix of stocks and bonds, with the exact percentage depending on their age, goals, and comfort with risk. The goal is not to beat the market every year, but to grow your money steadily while protecting it from big losses. He also talks about understanding your own personality as an investor. Some people are comfortable with more risk, while others prefer stability. Graham explains that your investment choices should match your temperament. If constant market fluctuations make you anxious, you might prefer a more defensive strategy with safer investments. If you can handle short-term drops in exchange for higher long-term growth, you might take a more active approach. Knowing yourself helps you avoid making decisions you will regret later. Another timeless idea is avoiding debt when investing. Borrowing money to buy investments can multiply gains, but it can also multiply losses. Graham warns that debt can put investors in a position where they are forced to sell at the worst possible time. By investing only the money you actually have, you can ride out market downturns without pressure. Graham also highlights the importance of consistent saving and investing. Even small amounts, when invested regularly, can grow into significant wealth over time through the power of compounding. This approach removes the need to predict the perfect time to invest. By putting in money steadily, You average out the ups and downs of the market and give your investments time to grow. The Intelligent Investor also reminds readers to be skeptical of market predictions and expert opinions. No one can consistently predict short-term market movements. Even professional analysts and economists are often wrong. Graham advises focusing on what you can control: the price you pay, the quality of the investment, and the patience to hold it. By ignoring the noise and sticking to sound principles, you increase your chances of success. A big takeaway from the book is that investing is as much about protecting your money as it is about growing it. A single large loss can wipe out years of progress. This is why the margin of safety, diversification, and careful research are so important. Graham also explains that true wealth comes from financial independence, not from following trends. A good investment plan should allow you to live life on your own terms, without worrying about short-term market moves. This means focusing on building reliable income streams and assets that hold their value over time. The ideas in The Intelligent Investor work because they are based on human nature and market behavior, both of which change very slowly. People will always get emotional about money. Markets will always swing between optimism and fear, and businesses will always succeed or fail based on their fundamentals. Graham's rules give you a way to navigate all of this without getting lost in the noise. Even though the book was written decades ago, the principles remain relevant today. Technology has changed the way we trade, and new financial products have appeared, but the basics of smart investing are still the same. Buy quality investments at a good price. Diversify, be patient, avoid unnecessary risks, and stick to your plan. The beauty of Graham's advice is that it does not require special skills, expensive tools, or inside information. Anyone can follow these rules. The challenge is having the patience and self-control to stick with them year after year. Many people fail not because they do not know what to do, but because they get distracted, impatient, or emotional. Graham also encourages investors to review their portfolios regularly but not obsessively. Markets can change, companies can evolve, and personal goals can shift over time. A yearly review is often enough for most people to make sure their investments still match their objectives. This might mean rebalancing, selling a portion of investments that have grown too large in your portfolio, and putting that money into areas that have become smaller. Rebalancing helps maintain your desired level of risk and keeps you from becoming too exposed to one asset or sector. Graham's approach here is not about reacting to the latest headlines, but about staying aligned with your long-term plan. The Intelligent Investor is not a book that promises excitement. It promises results for those willing to think logically, act with discipline, and give their investments time to work. By following its principles, you can protect yourself from common mistakes, grow your wealth steadily, and make money decisions with confidence. Graham's lessons are not just about making money. They are about keeping it, growing it, and using it to build a secure future.